Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over a bunch of different stock market and commodity type stuff from Twitter. I'll give you my financial opinions all about it when we go over it together. And we do have a 5 p.m. Mountain Standard Time Sunday Platinum question and answer session. You ask me whatever you want. I will go over a couple of companies. I'm going to give you my honest opinions and feedback on everything that I see in the markets. You get to see what I'm doing. I have my portfolio on the website. I'll show you where to find that if you're new, and you can see what I own. And we're going to go through here. There's going to be a lot of information in this one. We're going to go through some threads, and we're going to focus on not really the short-term market movements. It's about preparing for what's coming. And what I think that is coming, and in the short term, anything can happen. But what I think is coming is the underinvestment in a lot of these commodities have not and will not be solved very quickly. So they haven't been solved, and they cannot be solved in a short time frame. So let's dive in. There's obviously some other people that agree with that thinking, and I think that's the right train of thought to have when investing for this commodity bull market that we are in. So again, if you want to follow me, it's at finding_finance on Twitter, and you can definitely check out my website, finding-value.com. So I want to go into this thread here. Kevin, I think he's got his head put on straight. I'll just say that. He says, listening to Fed talk won't help, but instead knowing that massive printing is surely ahead to government deficits, but also to relieve pressure on banks and brokerages' balance sheets. They are currently behind the curve and will have to cut and print. The thing that is in my forefront here is it's the deficits, the government deficits that money printing is going to have to fill that gap. That will be inflationary, and it will be even more inflationary if they raise rates even further, making the interest payments on the debt worse. That is an inflationary tailwind that I don't think a lot of people are thinking of. I would say a lot of people, all they think about is what is coming directly in front of us. Maybe that's a recession. Maybe they're scared by price movements. Whatever it is. Big picture view, guys, government deficits, and then also the way that they're trying to slow this all down is just by basically slowing everything down. They can't do that forever. And the deficits in the system in terms of commodities have not been solved. So that pressure, that upward pressure on prices will continue to persist. It says government and Fed policy has dramatically reduced investment into energy, minerals, and general commodity production right when it's most needed at the end of a 10-year bear market. The result will be runaway commodity inflation. Totally agree with that. There will be consequences for printing trillions upon trillions of dollars. Perception changed slowly at first, then the herd takes over. When the herd comes for commodities, it's going to be explosive because there's so little above ground inventories, and the value of commodities and resource equities is minuscule. Completely agree. Governments and multinationals will seek to build inventories and strategic reserves of various commodities to protect against inflation. Investors will look to own commodities and equities to try to protect against inflation as well. The Fed is playing tough guy, trying to keep speculators out of the commodities and resource stocks, while also seeking to beat down the weakest in society, create joblessness, and reduce spending of the poor and middle class. But anyone who looks at history knows that our banks and their leveraged balance sheets can only take so much. Government debt interest costs are spiking, and revenue is falling. Corporate profit, cap gains, bonuses, income. The result will be blowout to a $2-3 trillion annual deficit. The Fed makes sure this deficit is funded via the purchase of Treasury bond purchases. This will send trillions of new money into an economy that is stagnant. This new money will continue to flow through the machine of government, pay government workers, politicians, Medicaid, contractors, military, and also fund infrastructure projects and ballooning interest payments. These funds trickle down to fund a huge percentage of the population, i.e. consumers. Meanwhile, the domestic industries that produce goods are starved for investment. On a net basis, $500 billion flow out of the country as goods are purchased abroad. The price spikes and supply chain issues will return and worsen over and over again during this commodity bull market. It's always hard to predict the number of years it will take to see the peak, but the peak won't come until we see record high pricing and record high profits for resource companies. I agree. So I think that's a really good thread. And I do agree with them. I think the inflationary pressures are there. I think that the banks can only take so much and they're going to need more money printing. And then since commodities are in a shortage, and if money flows into it from the demand side, I should say from the consumer side and from the investment side, it's going to create these gigantic price spikes in these equities. Now, here's something that I thought was interesting. This is the DXY trying to find something bullish for gold and silver. Perhaps this is a head and shoulders in the DXY. Left shoulder, head, right shoulder, perhaps, and then maybe a move lower. Again, that's not a prediction. It's just a possibility of what someone is noticing. Here's another one. It says, looks like the bond market is doubting the no landing scenario. 2s and 10s yield curve keeps inverting. The recession alarm is getting louder and louder. Now, here's the thing, though. When people said the curve was inverting, they said, oh, we're going to have this immediate recession. Well, we haven't. And this could continue to invert for a while. I think it depends on the pressures in the system, obviously inflationary pressures. And we very well could uninvert and have a little bit of a pullback or a recession. That is possible. But guess what? None of that fixes the commodity problems. Nothing fixes it. The inverted yield curve might delay it. Yeah, we might get a pullback. It doesn't fix the underlying problem. So if one takes a long enough viewpoint, they will be right. And we're at very low levels for commodity pricing, depending on where you are, given the cost curves and what sectors there are. So uranium is cheap, given its cost curve. Oil's pretty cheap, given the cost curve and the high cost producers of oil. Obviously there's always downside in the short term. That's always possible. But if the price can't stay down here forever, then what's your risk if you're patient? Your risk reward is very good if you're underneath the cost curves of your high cost producers. That is natural gas, that is oil, that is uranium. So those are some of the commodities that I look for, and it's below the cost curves. It says past cycles show that inflation, once entrenched, is hard to beat. And it has proven darn near impossible to beat without significant economic weakness. There is no immaculate disinflation. PCE data in line with recent CPI, PPI, and GDP data. Inflation persistent. So that's durable goods. You can see the inflation there. Coming on down, it says, deficits will persist but might shrink in the 2024-2025 period. This is for uranium. After which U3O8 supply deficits are expected to increase with a cumulative production gap of roughly 345 million pounds anticipated by 2030. Such a huge and dramatic setup for a screaming rip your face off short squeeze. I agree. Those who are positioned and patient will reap gigantic rewards out of this. And that is how I approach the markets. It's not trying to trade in and out of every single little movement. I take the big picture view, take the big picture deficit view in all these commodities, tie that with the credit expansion, and even if it contracts for a little bit, that's fine. And I just take the bigger long-term view and ride it. Now, it looks like Eric's doing the same thing. Eric Nuttall says, my main message on at market call today, energy investors need to take a breath, tune out the noise, and focus on what truly matters. Record oil demand, Willist, U.S. shale disappoints, OPEC spare capacity is razor thin, and super major production languishes. So we've got supply issues tied with record demand. And that's the bull market, guys. It's coming. This is energy ETFs have seen $4 billion net outflows over the last year as investors booked profits while very little new money entered the sector. After outperforming for 2 years in a row, three-peat is on deck with cash flows and buybacks running the show, plus possible tailwinds from inflows. So we've seen these net outflows. This has been the pullback, and I am suspecting, just like Shabam is, that this could potentially come back down where it starts to become net inflows. So not outflows, but net inflows at some point. Give it time, and it will come back around. He says the Fed pivot is bearish. These narratives around cutting rates are wrong. The stock market historically likes higher rates. What I'll say there is I view it just a hair different than what he does in terms of how I would explain it. The stock market doesn't like higher rates. I'll just say the markets in general, when they're strong, produce a higher rate. The narratives around cutting rates, the reason those guys are wrong about cutting rates is if you cut rates, that means that the market is inherently weak. So this here is a lagging indicator of how strong or weak the market is. So the Fed thinks the market is strong because they're raising rates. The Fed will, when they see weakness in the markets, will start to cut rates. And that's probably when you run for the hills because the market is weak. Now here's Josh. He says, inflation is bullish for oil and related equities. And this was from another graph that I've seen or chart. But energy equities do very well in inflation-adjusted total returns for asset classes from 71 to 81. That's where I like to be, energy equities. Now Luke says, what force is powerful enough to stop the U.S. military? A, compounding interest, which is undefeated all time versus hegemons. Alternate title, why weaponizing the USD is like giving ourselves a root canal with a shotgun. And that's, it says, you're exaggerating about how quickly U.S. interest expense will ramp up. Take the Treasury spending line item for F1Q23 from the latest TBAC report and multiply it by 4 to annualize it on a simple basis. This doesn't even fully reflect higher rates, and that's a 1.08 trillion. So that goes back to Kevin talking about those deficits they're running and how that's going to be inflationary. Looks like Luke also agrees with that. Here's XAU to gold ratio quarterly. It says our miners getting ready to run in the second half of 2023. We've got potentially a inverted shoulder, head, shoulder playing out in a larger, bigger picture view falling wedge. So that is one thing I wanted to show is that falling wedge with this, kind of a nice looking chart. I know in the short term, things are pulling back in precious metals. That is usually when I get greedy, is when everyone else is losing interest in a sector. Now, I'm not quite greedy yet, but I will be. And for me, I might not play the XAU gold and silver mining companies as much, but I will play the physical metals quite heavily. Now, here's the big picture view that there's still a massive divergence between gold and TLT, which is bond prices. Something broke late 2021, it seems, and a 47% haircut for long-term bondholders in 2.5 years has to leave a mark. So there's this gap here, and it started in 2021. We saw that there was a correlation before with bonds and gold, and now there is a divergence. In my opinion, that divergence occurred when interest rates started to shoot higher. And I think that divergence will continue going forward. I don't think this gap will close. I think it will get worse, the gap. It'll actually expand. And that will be due to the reluctance of people to buy U.S. bonds from different countries. The U.S. dollar reserves, I should say the reserve currency and the doubts around the reserve currency and oil and other commodities being traded in other currencies rather than the dollar. So I do think that this could diverge over time and stay separated. says, this is Tavi, it says, the number of comments arguing against this analysis is incredibly telling. Investors are conditioned to value assets as if this was the beginning of another decade of high growth and low cost of capital environment. The next 10 years may surprise a lot of people. What he's talking about is Microsoft is larger than the entire sector of the S&P energy or S&P 500 energy sector. That is ridiculous. This is so going to change in the future of the next 10 years. And everyone is looking at it like this hasn't changed yet. And it hasn't yet. But they're going to, I agree. I think they're going to be surprised. Now, here's Eric again. It says, Fed speak, rate expectations, recession fear. It's all noise. Tune it out. In a world in which I believe oil demand will grow for at least 10 more years, this chart is what matters. The fear of peak demand is leading to the reality of peak supply. And this is your real upstream CapEx per flowing barrel. So here's your flow, and this is the dark line is your CapEx, your upstream oil CapEx here as we go up and down. We've been down since 2013 quite a bit in terms of CapEx. This has to go up, and it has to go up at a dramatic fashion because we're finding less and less oil in the world, and it's getting harder and harder to extract. Here's Norway's total liquids production came in below 2021 levels and missed forecasts every single month in 2022. This is despite their flagship field at max capacity. Legacy oil production is declining faster than expected, thus adding to future supply shortfall. And this is what I focus on, guys. The supply side of oil is jacked. I don't know how we're going to raise oil production 10 years from now. You know, have a steady oil production from here to 10 years out from now. I just don't see it. And that's why I'm so bullish on energy just in general. Because I don't see the path. And just because I can't see it doesn't mean it can't happen. But the world is declining. And I'll just do 10 million barrels. So the world's decline rates, let's just say, are a 10 million barrel per year. That means every single year we need to find 10 million barrels of new production to stay flat. In the next 10 years, if we were to stay flat, just to stay flat for the next 10 years, we need to find 100 million barrels of oil production per day. That's how much we have to find. I don't think we're going to find that. And that's where I put my money. I put my money in oil and the areas that have, I'll say, good prospects that can still grow their production, while the rest of the world is going to really hurt in terms of production, supply, growth. And this is just one example of Norway. Here's uranium. I said URA looks good. Single line is all that is needed. And I just put it right under this support area, a little bit of resistance, support, 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 support. And I think eventually this will turn up and head higher for uranium. This is oil prices. What I said is oil and natural gas look good to me. Perhaps Livermore accumulation cylinders. Some people got all mad because about the accumulation cylinders, but I still think that's what it is. I think this will eventually work its way higher. That's when it was at $76. I posted this February 23rd. And natural gas also putting in a big pattern. Some people said this is the entire pattern. That very well could be. And it could also be something of a larger pattern that will get a big move. But we'll see. I also think the Baltic Dry Index had a false breakout and a move higher likely. Super cheap valuations. This was before, no, this was after the 20% move, but this is a false breakout of this falling wedge. And then I think we're going to get a slingshot to the upside along with oil. So the Baltic Dry Index trades very closely with oil. Conversely, oil trades closely to Baltic Dry Index, and they kind of both go up together. And we are seeing the Baltic Dry Index at a very cheap level compared to history, and we've got the falling wedge. So very positive things. This is the Baltic Dry Index divided by crude oil. Baltic Dry Index is very cheap to crude oil. And if you notice, these went up during the beginning kind of stages of that third leg in oil. So I think we can see a big move to the upside in Baltic Dry Index potentially. And on the website, I have some potential dry bulk shipping companies to take advantage of that move. I asked everybody if the CRB index is consolidating. Well, it is consolidating. Are we going to break higher from here? Are we going to break lower from here? Are we going to get a false breakdown? Are we going to dive lower to the fib retracement level of 0.618, which is a lot lower from where we are today? I was just asking, what do you think? You can put it in the comment section. I still think platinum looks very good. We've got these long-term charts, and the ratios are all cheap for platinum. I think platinum is the superior metal in terms of valuation standpoints. It is very cheap in relationship to gold, and we will eventually, I think, work our way up on the ratio. We are very cheap in relationship to palladium and moving higher. We've got platinum to silver, and that also looks good as we've broken the downtrend, and we're just sitting on top ready to break on higher. Give it time, and I do think that we could see a little bit more downside in the very short term with platinum, and then we'll get that rocket move whenever that reverses. So I've got all that. I'll stop it there. And again, we've got a 5 p.m. Mountain Standard Time Sunday for the Platinum question and answer session if you want to join. I'll see you there, answer whatever questions I can. We'll go over one or two of the companies. We'll go over their presentation together. I'll show you why I'm really bullish on a few of these companies. They've got some really good setups. And I think looking forward, they've got really good production growth. So that's what I've got for today. Thumbs up for the content. Subscribe to the channel if you haven't already, guys. And we'll catch you next time. This is Finding Value.